Hello again, everyone. I'm Greg Towner, and welcome to the Parallel Portfolios market update for the month of August. Let's jump right into it here. Some of the topics that we want to cover are the price trends, both in the U.S. and internationally. We want to take a look at how the second quarter earnings turned out and how stocks reacted to that. And then, importantly, now that we're entering a key seasonal period, we want to see what that might mean for equities as we move forward. So if we look at the S&P 500, we can see here this red line, the 200-day moving average, still in a nice intermediate price uptrend. Nothing wrong with that, very healthy. But as we drill down a little closer to the shorter term, we can see a little bit of a perhaps rounding top. We'll see. Yesterday we had a key close below the 50-day moving average. So with all this space here between the yesterday's close and the 200, certainly couldn't be unexpected to have a little bit more of a correction, which we haven't seen one of those in a while. But we could have a little bit more correction and still maintain our nice, healthy, intermediate term uptrend. If we move on to international, very similar picture. International has actually been a little bit stronger. But again, a little bit of pausing here in its uptrend, but still, even if it did correct, could still very well be well within its intermediate term uptrend. Now, for those of you that have listened to our last 2 or 3 months calls, you know we've talked a lot about both international stocks and the health of earnings. So this chart is actually going to allow us to take a look at both of those things together. On the left side, we have these bars that represent S&P 500 earnings in the second quarter, the earnings growth, and the sales growth, revenue growth on the right side. The dark blue bar in the middle is the growth for the quarter for all S&P companies. Nice 10% growth, really healthy. The lighter blue bar, 8.5% growth, is S&P companies with more than half their sales here in the US. And then the green is more than half their sales internationally. So we can see that companies, particularly the larger ones that sometimes get extra amounts of sales internationally, we can see that they did really well in the second quarter with their growth. And some of that is to do with the decline in the US dollar. But in general, seeing some really nice international growth, started to pick up steam from the US economically. What we've also seen is companies really beating expectations for analyst earnings. Across the board, almost all sectors really very healthy. Energy a little bit weak, only around half the stocks beat their estimates. But everything else in the 70s and 80% of stocks beat their estimates, tech even over 90. In fact, for the second quarter, we actually had the most companies in the S&P 500 beat estimates going all the way back to 2004. So very healthy action in earnings as well as economic data. So that's where things start to get a little bit different. The story changes a little bit. So we always like to see companies beating expectations, but then we like to see them acting well because of that. So over here on the left, we have positive earnings reactions. Normally, when a company beats earnings, the stock jumps by about almost 1.5%. That's a good sign. You want the stocks to go up on good news. But here in the second quarter, even for stocks that were beating estimates, they actually declined that day by a little fractional amount, 0.3%. So it's just the opposite of what we want to see. And then on the other side, negative earnings announcements. Historically, over the last 5 years, they've declined about 2.5% on that announcement, and they still did that. We'd rather see companies actually go up on what is perceived normally as bad news. So the exact opposite of what we'd like to see there. We really think it's no coincidence that that is starting to happen in the sometimes negative seasonal period that we've talked about. August is sometimes weak, starting in the middle of August, and September is often weak. In fact, it's usually the weakest month of the year. Of course, that doesn't always hold true, but we think in this case, things are kind of coming to a head at the same time, and the market is perhaps just a little bit tired, and it coincides with the seasonal period. So where does that leave us? Price trends remain very healthy. If we look out intermediate to longer term, price trends are still very strong. So not any real concerns there. Earnings have been strong. The economy has been strong. Those are all still look good. But the average reaction to positive earnings indicates the market might be a little bit tired, basically. We've spent a long time since we've had any kind of notable correction in the market. Investors might get a little bit complacent, sentiment get a little bit too rich. We don't think it's any coincidence that maybe that is aligning with what is commonly a seasonally weak period. Catalysts that maybe didn't matter before, whether it's DC turmoil or geopolitical events or what have you, those things sometimes don't matter until they do, so to speak. and it's occurring now with seasonal periods. So volatility could continue to pick up a little bit. A couple of the reasons that we're not worried that it would turn into a major bear market and is likely to be just a more normal correction. We don't see a very high risk for recession. Global economies are still pretty healthy. And also credit markets are healthy. That's always a key. You want to see bond markets behaving well, and they seem to be so far. So we're going to keep our risk management plan in place. We're always going to have a discipline for that. Could be some increased volatility as we move forward here in the seasonal period, but we're still going to be looking out longer term. So thank you for joining us, and we'll see you again next month.